And for more on this, let's bring in Paul Kalogirou. He is Managing Director and Client Portfolio Manager for Global Multi-Asset Solutions at Manulife Investment Management, joining us from Hong Kong. Paul, good morning. I mean, a lot of focus on the COVID situation in China and how they are loosening those restrictions as days progress. But are you expecting a shift to economic growth and recovery from COVID concerns when it comes to policy and when it comes to stimulus measures?
Yeah, I mean, the measures that have been announced are really sort of China pushing back from the real strict measures that have been in place. And that in so many ways is offering some opportunities within sort of equity and then debt markets. And it means ultimately we're seeing some support there. I think we'd be maybe more skeptical in terms of China moving towards a zero COVID policy and policy becoming completely open. So I was sort of a little bit skeptical on China reopening theme. But nevertheless, they are pushing back on some of the more stricter measures, which is positive for the markets. And therefore, we've had some of these real good rallies in equities and debt. We've seen some of the property measures that have been announced, which are very supportive for the property sector, particularly some of the credits, which should be seen as positive for that sort of at least those steps into the China market or China reopening. I think what is sort of what we should be watching is around vax rates or vaccination rates within China. China still needs to push out vaccination rates into the 60-year-old and 80-year-old plus in order for them to feel more comfortable with sort of further steps into that reopening. So yes, this news is much more welcome, and there is an argument that China downgrades COVID from a severe infectious disease to maybe a category B type disease, maybe next year. So yeah, these are initial first steps that can get China moving again and get those mobility levels back up again.
Yeah, it's still a long road ahead when it comes to China fully easing COVID controls, Paul. But when you look at the markets, those early reopening plays have gained some ground. There's a rally in that part of the market. Is it too late then to try and capture some of those gains, or are you looking at other parts of the Chinese market?
Yeah, I mean, when we look at China, I mean, we've been positioned for a recovery in China. We've had to hold on to some pretty challenging positions, particularly around credit. And so what we've seen is those measures that have come in place to support the property market, they have enabled China credit and property developers to maybe recalibrate their financials going forward. So it gives them sort of a 6 to 12 month window to really sort of sit back and recalibrate and sort of take on some of that support. I think when we look at structurally within China, transaction levels for property still remains sort of under some sort of pressure. I think purchasing of property still remains under pressure. So I think there's a lot more to do. I think we've just gone from very, very bearish on pockets of the Chinese market to maybe less bearish, and then you've seen a recovery in some of these issuances where you've gone from sort of 20-30 cents on the dollar, which have recovered to sort of 60-70 on the dollar. So that's where we've been positioned in terms of, getting that yield and getting some of that recovery back into the portfolio. Some of the performance that we've lost, we've held on to some of these securities over the course of the last 8 months and now sort of paying back some of their dividends back into the portfolios.
And Paul, when we take a look at the broader markets, we got a negative handover from Wall Street over concerns of their shift when it comes to Fed rate hikes. But then you've got this reopening in China. Is it time to increase your risk appetite when it comes to global markets?
Yeah, I mean, the market is certainly reacting towards the Fed doing, less heavy lifting going forward. I mean, we'd be sort of a little bit more skeptical around that, and the market is certainly looking for maybe the 50 basis points hike at the next meeting. Whether they do go 50 or whether they do go 75 at the next meeting, I think it's sort of the jury's still out there. But we're very much on the sort of base case around, more of a stagflationary environment. So inflation still to remain elevated, growth to slow. And therefore, we've still got these fairly tricky markets to navigate over the course of the year. So to add risk is a little tricky. I mean, we still think that, relevant to this market is the sort of lower beta equities, those with more defensive attributes, should still remain relevant in this type of environment. So it's a tricky market to sort of get your heads around. But I think ultimately we're staying sort of maybe slightly adding of risk into these markets, but not overly sort of pushing risk or pushing the pedal down into risk assets currently.
It might get tricky into 2023 as well, Paul. Thanks so much for joining us today, Paul Kalogirou there from Manulife Investment Management.